Hi, once again, Dave Knight here from 123daytrade.com. Thank you for watching. Thank you for being here. We're continuing our foundational day trading course here. We're working with part 2 today. I felt like we didn't spend enough time where I wanted to, so I kind of wanted to go as a review. We want to talk about the open, high, low, close. On the foundational course, we're not going to cover candlesticks. The candlesticks, we'll bring that in the intermediate course. We'll also bring it into advanced a series that I'm going to look at in the future. But for now, let's have something to work with. The open, high, low, close, we're going to once again review what makes a red bar, what makes a green bar. What we're going to add to the charts today will be the 200 bar simple moving average on a closing basis, the 50 simple moving average on a closing basis, and we're going to add a Williams percent R. We're going to add one oscillator, or kind of like a momentum indicator is another way of looking at it. So we're going to add that on today. That'll be part 2, and we're going to look at one specific type of thing that we'll be looking at on setup. We're going to go start the day chart, and I want to work our way down to the 10-minute chart. That's kind of our goal that we're looking at as an overall right now. So eventually we're going to be going from a day to an hour to 15-minute, and we're going to stop at the 10-minute today. We're going to just use either a 10 or a 15-minute chart, depending upon which one I like to use better at this point in time. Right now we're looking at the day chart in front of you, and I've blown this up a little bit better so that we can see the insides of each bar. So what I want to do is a quick review and just go over what the open, high, low, close looks like. So we're going to use this bar right there for our red bar, and let's use this bar right next to it as for a green bar. Now, very simply, here's your open, here's your close. So what produces a red bar is the open is higher than the close. This is the low, obviously, and this is the high. So the OHLC chart, that should be an H, is called an open, high, low, close chart. So this is the way I like to look at the bar charts. Now, if we wanted to say a candlestick in here, this actually would be the filled part of the candlestick right here. So we'll get into candlesticks, and like this side right here would be the filled part of the candlestick right in there. So we'll get in candlesticks like I talked about in the intermediate side. But for now, let's simplify things down. Let's just look at the open, the high, the low, and the close. The green is the exact opposite of the red. The open is lower than the close. So in this case, that produces a green bar. So that is how you produce a green bar and a red bar if that's what you have in your charts. Now, you don't have to show it this way. You can have them any color you want. And when it's equal, let's see if we can find an equal bar. It's called a doji bar. Let's see if we can find a doji. You usually can't find a doji on a daily chart. So when we see one eventually on like a 15-minute or a 10-minute chart, I'll show you what a doji bar. What that means is the open and the close are exactly equal. It's called a doji bar. It's a Japanese term. All right, let's move on. And what we want to add at this point is our 200 bar SMA to the chart. So if we push this button right there, that's going to add a steady. And what I like to do is just put simple in here. And what we're going to do is just add this, and then we're going to edit it. Properties. We're going to go down to where our, let's find it first. Okay, so this is a 10 period. So the first thing we want is a 200 bar SMA, and we want to change its color. And then we're going to have to go find it. All right, so so we added, this is a 10 moving average. I want to get rid of this one. I want to get rid of the 10. And now we need to, now how we get, this is a CTS platform, so what we need to do is lower our charts so that we can find it, right? So first we want to do this, and then we want to come down here and find our 200 bar. And then we want to hit our A button so that we can locate our 200 bar SMA. Let's get this a little bit better. That works a little bit better. All right. So this will produce as it moves out. All right. So this is our blue line. This is our 200 bar SMA. And how we look at the overall trend in a market is the slope. So once again, as we're looking at slope, you can definitely tell the slope is moving down at this point. That makes the trend in this case. And if we're looking at the daily chart itself and the trend and the slope is down, that what normally means is that the short side or the sell side, the market is more apt to go down than to go up. And you can see that that obviously is correct in this case. So that's how you look at the overall market. But more importantly, what I really want to concentrate on is when we move down is looking at, let's add the 50 bar on in just a minute. But let's go down to the hourly chart. All right, and let's hit the A button and see if it auto puts everything in for us. All right. So here's our hourly chart. And if you're looking at this, I want to look at this part and I want to look at this. So when we talk about the bell curve, normal distribution curve, once again, what you're looking at is reverting back to the mean. So here is a cycle high, and here's a cycle low right here. We're going to talk about a little bit of cycles as well in this little conversation for a little bit, and we'll get into it more in part 3. But when we're talking about reverting to the mean, this is the mean. So the center of the bell curve, as it relates to day trading, and you're looking at the day chart, is where is the 200 bar. So for instance, when we move this over here a little bit further, you're going to see that we're going to come back down to the 200 bar as well at some point. But right here, the high, and we revert back down to the mean. So that would be like over here and coming back to here to the center. And then you see this over here, that's like over here maybe roughly, not that far away, maybe it's even within here. And then it comes back towards right there to the center. As it moves back up, it's right back to the center of the bell curve, the normal distribution curve. All right, so then we have their standard deviations. So this would be 1 standard deviation away, maybe 2, 3, and then 4 and 5 way out here. 4, 3, 2 here, 1 there, 1 here, and then 0 right there. Standard deviations away. So maybe this right here is basically 1 standard deviation. This might, or maybe this is 2 standard deviations away, and this is 1 standard deviation away. I don't know. I would have, without plotting everything, it's hard to tell. But you can see that the odds of it coming back are great because everything likes to come back to, think about water. Water always seeks its own level. That's a great concept to think about. So when the wave comes out, it'll come back down. Wave comes out, it'll come back down. Wave comes out, it'll come back down. It'll go lower, but it'll come back up again too. Kind of like and that's what we're going to talk about an oscillator as well today. We look at the Williams percent R. All right, so let's add, at this point, what I want to add to this chart is actually bring it down to our 15-minute time period. And I want to find it again. Let's add some more bars in. And you can see that each bar in this case, or each time frame that we move down, it defines the 200 bar simple moving average. So this is a 15 minute. So this, if we would count back 200 bar closes from this point and go back 200, the 200 closes is where this is coming in right now, $34.24 or $34.24 in the crude oil market. When you look back, 200 closes. So if you look back, another way of looking at this is a simple moving average on, in this case, let's move to the 50 bar. So what I want to add is another study. You can right click, by the way, inside the chart. And I want to add this, in this case, what I want to add on this one is the simple moving average, and we want to add a, after we add it, we're going to make it a 50 bar, and we're going to turn it yellow. So let's find it first. All right, so this is it right here, 50, and I want to make it yellow. I like to see, I think that yellow is, and then let's do one more thing to that. Let's make this line darker, or more easier to see. So let's go to 3 on that, and let's make this one 3 as well. All right. So now we're looking at a 15-minute chart. When we're looking at the overall trend of a market, what you want to say is, where's the 50 bar, where's the 200 bar? If this was the, let's go back to the daily chart, because the daily chart lets you determine trend to start with. If the 50 bar, you see it's crossover right here. So you see the cross, why isn't that printing a little bit more? This 200 bar should be printing more. Let me pause this video, close, and reopen. All right, I'm back, and it's like I've never was gone to start with, right? So there we go. I want to see this print more. All right, so we don't really need to see that. We'll look at it a little bit later. But you have your 200 bar, looking back 200 bars, and you see your 200 bar right here, and you see it slanting down. So the slope at this point on the daily chart, you can see that it's down, but more importantly, you can see this crossover coming over here. So this helps you determine trend. So trend is your friend, they talk about. So at this point, right around here, you notice that the market crosses over, and the short, in this case, the sell side of the market, is stronger than the buy side at this point. So this crossover of the trend, and you always want to keep that in mind if you're moving trend or counter trend. So trend in this case would be to short or sell the market, as you're looking at, if this is the only thing that we're looking at. So let's move to the current market. If you actually push your home key, it'll move to current. So this is what the market looked like today. Open, high, low, close, and actually it looks like it's an inside bar, actually. Inside trading bar today on Monday, which, believe it or not, doesn't happen very often, but it does happen. Well, it happens a lot in a congestion period. So what we're looking at this point, you can say that the trend is down, right? So there are 50 bars underneath our 200 bars. So this is our 200 moving average, and this is our 50 bar moving average. So when we're looking at trend, always you're going to go to the day chart, and you want to determine what trend is, what counter trend is. So counter trend would be trying to take a long into this up through here, and going trend is basically thinking the market is actually better short side than a long side. So what this really means is that it's easier to take on a short trade more times than not with the trend. So in this case, the trend is down. The short side of the market's a little bit easier to take a trend. Although there's a lot of great times where you can take a parabolic trade where the market comes off quickly, and you can take a nice long trade as well. So don't think that you always have to take a trend side trade on the daily chart. It's just how you determine trend. In this case, when I say trend, what I mean as a downtrend, the overwhelming downtrend, this case is the daily chart is a downtrend, and the counter trend to that is up right now. Now, if the 200 bar was above, or if the 50 bar was above this, then the uptrend would be the trend, and the downtrend would be counter trend, so coming back towards this way. But if we're talking about going back to or reverting to the mean, then if the 200 bar would come down here and the 50 bar comes up here, that would be your normal distribution curve, roughly, where those two intersect. Up here is a perfect example of where the bars intersected, and this would be the absolute center between the 50 bar and the 200 bar. Right where those crossed is where the bell curve, in this case the normal standard the normal distribution curve together, the 50 and the 200 crossover, roughly about this area, is where the center of those two meet. Right there is also the center of the distribution curve as well. Hopefully that makes some sense. So let's move down from here and let's go into, I want to go to the 10-minute chart because this actually shows you the 200 bar and the 50 bar a little bit better, and we can play with it a little bit more. What I'm doing is I'm adjusting let me widen these line thickness out a little bit. There, that looks a little bit better. So the open, high, low, close, and let's just get them together where I like it looking. Let's play with this a little bit, and then let's do this. All right. And let's find a crossover on the 10-minute chart. Right here. Okay, this is a good cross. So if you think about the standard deviation, a normal distribution curve, once again, hopefully I'm hammering this in a little bit more. And this is your 10-minute chart. So if your 10-minute, and let's say this is your trading chart, where this crossover happens, right there is right there at the center. So right here with this cross is the center of the standard deviation curve in relation to the 50 bar moving average against the 200 bar moving average. So right there where they crossed, roughly on, let's see, I don't know what day this is, but it's 11:30 roughly on whatever day this is, that this crossed right there. And then you can see this moving up. Now, the 200 bar is still coming down, though. It actually doesn't physically start coming up till we're over here a little bit. So the slope can be important as well to determine which side of the market that you want to be on. So this is kind of hard to tell just straight going 50 to 200 bars. For instance, I want to be long when the crossover happens. Well, you go up here and then you get this knocked out. That's obviously not, and you'll see systems being sold this way, right? I want to go long with the 50 bar crosses the 200 bar. Well, that's roughly right there. That's just about the high of the market. And you're like, I want to be long above. Well, no, you don't. In fact, if you would have taken this crossover trade, let's say you get up here at 34.20 and you can get knocked out at 32.90. That's almost a $1.5 thousand loss by going long up there, right? So you need something better than just simply saying, oh, well, I want to trade when a crossover, simple moving average crossover. Not such a great thing. What you want to use this for is just trying to figure out where is the trend and what is the counter trend in any given time period. So in this case, if we're looking at strictly the 10-minute chart, at this point in time where it crosses over, the trend side is an uptrend and the counter trend is coming down this way. That's how you look at trend versus counter trend. And up here, where it did cross over, you'd think, wow, that'd be a great place to go long, but in fact, it went down. So just because the cross happens doesn't make it a valid setup. All right? So keep that in mind as we relate to it. So the question that comes up at this point, is there a way to look at the market a little bit better to help you determine, is it really a high or really so it's the cycles. And we look at a cycle movement. Let me smash that in a little bit. So if we look at cycles, this is a cycle high up here. And this, let's just say this is the low. Here's a cycle low over here. So we see that the cycle low, came back to the mean, and it looks like the cycle low is getting really close to coming back to the mean right here. The cycle high is coming back to the mean as well. It came back to the 50 bar mean. It came back to the 50 bar mean right there, 50 bar simple moving average. Came back to the 50 bar simple moving average right here. And it looks like if we would move this forward a little bit, yes, we did. We went underneath, and so let's use this as a cycle low, and this is a cycle high. This is a perfect example right now as we relate to the 10-minute chart. So here, is there a way to be able to determine if this would be a good trade to come back to the mean here? So if we would have been able to catch this from here, 31.60, and catch it up to here, 32.70, that's a $1,000 move. Actually, it's a 110 tick move. Catch it from high to low, or catch it from off the low here going up to the mean. That's a $1,110 move to catch it that way. And up here, that's roughly what, 34.15, let's say, coming down to here at 32.70. So that's actually a 1.5, like 150 roughly. So that's a $1,500 move coming this way. And so you're looking at roughly 1150 to what, 250 into the nighttime, and this would be the morning. So this is the overnight session coming back into and running back to the mean. So what made this the high? What made this the low? Well, you need another way of looking at the market. In other words, need to look at it a little bit better, and this is where we're going to bring the oscillator in, the Williams percent R. So let me pause while I put it on, and then I'll be right back. All right, so we've added the oscillator, the Williams percent R. It was developed originally by Larry Williams, one of the traders that I actually consider one of the masters out there. He wrote a really good book, by the way. If you don't have it in your trader's library, I'd highly recommend getting it. It's How I Made $1 Million. How I Made $1 Million last year trading commodities. He wrote that in the 70s. It's some really good information that you can glean from it. Now, he hadn't invented the Williams percent R back then, but it's one of his inventions. And it's a momentum oscillator that helps you determine trend, and also can be a good tool to help you determine if you want to be long or short in combination with some other things. So if we just look at the oscillator itself, let's minimize the price chart, and let's just look at the oscillator itself. If we're looking at the oscillator itself, what we can see is this is the overbought section up here, and this underneath here, when you see it underneath here, it's the oversold section of the charts itself. So you can see you're overbought all the way through here looking at this, and you would think that this would be a great time to sell it here. Looks like a good time to sell here. Possibly a good time to sell right there if you're just strictly looking at the oscillator itself. But you have to use price charts as well, right? So just because one thing looks good doesn't necessarily make it good. So we can see that this little period of time, let's go back and look at it. So we were looking at this first move right there, coincides with this. Oh, that looks pretty cool if we could have caught that. This right here, not so good because we didn't go underneath, but we see this one here, there's nothing there. And we see this over here, and that coincides with that little move right there. So the oscillator itself can help you determine when you see it above like this, then more times than not, it's not meaning that just because it's above and goes below doesn't make it an automatic, oh, let's sell the market. And just because it goes this way doesn't make it an automatic buy, although this goes with this and shows it a buy side. Just because you see it this way, you just can't. And what I'm trying to get at is just because this says this looks good here, you're going to get caught. Like for instance, if you tried to short this little area right here, you know, you got yourself caught on that side. So it's not it's not a by itself. You can't trade it. You can't use, but it can help determine where some good trade setups can be. And a lot of times you're looking for convergence and divergence is the best way that I can look at it. So let's look at a specific setup. Let's try to find some nice little setups here. For instance, let's look at this low. So we're going to look at that two and that. So this is coming down and this is going up. So what we see is a divergence here. So you have a divergence, this low and this low right here. So what you're looking at, this is the lower low and this is a higher low. And you're thinking, okay, is this a good setup to be going long here? Well, if you're looking at the oscillator itself, you'd say no, because it's making a lower low here. It's not, this low itself is not as strong. So this, in effect, could have done this just as easily as it went up right there. And we'll take a look at some areas. So right there is like kind of like a situation where should you trade it, should you not? Well, the slope is this way, right? It's actually coming down. Should you even be taking a short with the slope coming down at that point? Maybe not. You see the slope coming up this way over here. Let's look over there. Well, here's a nice little slope. All right, so let's look at this move right here. Let's look at this move to this move. So, and we see that our slope is moving up a little bit, right? So if we look, let's grab this, is right around here, and here is right around there. So this is going up like this, and this is coming up like this. That's looking a lot better, isn't it? And you see our slope is coming up. Where would you want to be long from? Well, roughly right around here. And you see this move coming up here, and maybe you're exiting the trade right around there. So you see this move right here, it's roughly right 33.55. And if you would have been perfect, that would have been a dollar move right there that you could perhaps have caught. Or are you exiting right here at the 34.25 mark? You got yourself about, let's say you got in at 33.65 and you exited at 34.25. That would be what, 40, 60 ticks. So that'd be a $600 move right there, going with the trend, plus 60. So a nice little setup right there that you could have taken advantage of. This is a nice little setup. You have your divergence here. Convergence. I guess that's the best way of looking at it. And this are going together. So let's find another setup. Let's look around here and see what else we can find. Here's a low setup right there, and this is making a lower low, and then the market goes up. So just because it's down below, what I'm getting at is nothing is perfect, and just the oscillator by itself doesn't really help you. So for instance, here's a nice little setup right here. Let's look at this one. So you see, let's see here. We have this high here, and we have this high here. And you're thinking, well, that should make the market go up, you would think. So this coincides up here, and then you see this. And then the market comes down. It can be very confusing when you're looking at convergence and divergence. Then we see this right here, right? And then we see this right here. Now there is a good move. Why is this different? Why is this one a better to take it going back to the mean? Let me show you. Let's get specific right here. What you're looking for is a divergent setup, the way of looking at it in a sense. You're looking at the low pattern against the oscillator pattern. Do you see something here? So this low and this low against this low against this low. So it's making a lower low pattern, right? But our oscillator is telling us that, hey, there's a divergence here between this low to this low. Therefore, it's stronger to go back to the mean at this point. So, and you can see that, yes, it does. Let's find another one. Let's find another good one. Here's a good setup. Here's with the pattern itself, right? You have your downtrend, and you have these two moves right here. Not so good, but let's just look at it in a sense. So here's these two lows. This coincides with this. So we have this move like this. We have this like that. There's your long coming back to your standard deviation curve, or that normal curve, right? Coming back to the 200 bar. This is a nice little counter trend move on the 10-minute chart. Let's look some more. Here's a nice little setup right here. Let's look at that. So you see your slope coming this way, and you see this moving up like that. There's a divergence setup. It's making higher highs. That should be HH. It's making higher highs on the 10-minute chart right here. But you see this is coming, the oscillator itself, there's not a lot of momentum behind it. Therefore, when you see the crossover at that point, it's a good chance for the market to come back down. And you can tell that most likely it ran, let's see if it ran down here over here. Yep, there it is right there. 32.70. So if you would have caught that move, I think we looked at that before. That's that $1.50 move that we looked at before. It's a nice little setup. Here's another setup. Let's look at this right here. And we'll make this one our last one. Look at this one right here for the day. All right, so we have this right here and this right there. There's a nice divergent setup, right? Just need the crossover to come across to take it. And look at that move. This is your crossover pushing away. So this is a great, when you're looking at the there's two things that you're looking at. You're looking at the reversion to the mean. This trade itself is going away. So the parabolic move. So this part of this going out and away, this would be like this trade right here coming from center, going out like this. So it's the parabolic move coming away from the mean. Now most likely, if we go here and go right edge, we'll see that it comes back, or this 200 bar comes back up and it catches it later on. But it's a nice little setup to be able to take a set profit. So we'll look at ways of taking advantage of this and try to find out where would, you know what, let's just add it on right now so you can see kind of what I'm thinking about. It's called a Fibonacci Extension, a little bit more than that you need to know at this point. But there's your 100% that you could easily run from entry point. Let's say we got in right at the crossover here. Let me make this yellow. So let's say that we got into the crossover right here. This is where we would have found value. We see the divergence set up, and now we just need to cross over the 50 bar at this point. So here's our 50 bar crossover around 33.08, and we wanted to take a shot at the extension going to 34.63. Once again, about a $500 move that you could have taken advantage of. It comes back here and knocks you out. So just an extension of way of looking at it. Let me get this off. There, see it run back down here. And in fact, here's my trade for the day that was worth 40 ticks. And what did I do? What was I looking for? I'm still doing the basic stuff, right? I'm looking at things the same way you should be looking at it. I'm looking at the standard deviation. And what did I trade? This trade here, I wish I caught it up here, by the way. But what was I looking at on my trade today? I was looking for the reversion back to the mean. In other words, getting back the 200 bar SMA. And that's what I was looking at on the 10-minute chart, but I trade on the tick chart. But when I'm looking at the 10-minute chart, I was looking at the reversion back to the mean to come back to it, to push back to the standard deviation side or the middle of the curve or the normal distribution curve. I hope this makes sense to you. This is 5 minutes over. I wanted to just briefly bring in a few tidbits to a little bit of a conversation. So today is a review. We looked at the 200 bar SMA on a closing basis. We looked at the 50 bar SMA on a closing basis. We drilled down to the 10-minute chart to help us make some trading decisions. And then we looked at the Williams %R, and the setting that I used today was 54. Everything is going to be based on 3, 6, and 9s. We're going to talk about that in the future as well. Is 54 divided, if you take 54 and divide it into 9, is that 6? 9 divided by 6, yeah, it's so there's a 6 in there. There's 54 divided by 9 is 6. 3, 6, and 9s. We use an awful lot in our calculations. 3, 6, and 9s. There's a lot to it. I don't want to delve into it too deep. More of an advanced concept, but I wrote a blog post on it before. When you look at Nikola Tesla and William Delbert Gann, 3, 6, and 9, the power of using 3, 6, and 9. Don't want to get into too much right now. Just understand that the Williams %R is based upon the green line that you see coming across the charts right now is 54. It's a 54 period. All right. This is Dave Knight here from 123daytrade.com. Thank you for watching. Thank you for being here. We'll talk to you a little bit later. Bye for now.